Andrew is in D.C. Hey, Andrew, welcome to the Dave Ramsey Show.
Yes, hi, Dave. Had a question to you about investment real estate. So my wife and I, we bought a new house in November of 2019, so just about 8 months ago. We had really strong equity in that previous home, and so we decided to keep on to it and to rent it out. So since we didn't sell it, we could only put about $160,000 down on our new house. If we had sold the old house, we would have profited around $385,000 off of that sale. So therefore, we had to do a 30-year mortgage on the new house simply for cash flow. Now, the old house is going to be paid off in about 4 or 5 years, and our plan was to take that rental income and apply it to our new house to pay down the house faster. Additionally, so I guess what I should say is we reworked our budget, and we've got about an extra $2,000 per month we can put down against our new home, our current home, to pay it down. But I was wondering if we should start saving that extra $2,000 per month now and buy another rental property maybe next year, because I know that real estate is such a good investment. So wanted to get your perspective on that, please.
Well, as we have studied people who have a net worth of $1 to $5 million, the data tells us that one of the two things that caused them to be able to achieve that mathematically was their 401k and Roth IRA and steadily investing. The second was that their personal residence is paid for. And so that proves out what we have said for decades around here, that the shortest distance between where you sit today and becoming wealthy is to avoid debt, because it lowers risk and increases cash flow. Nothing in your story parallels that idea.
Okay.
So, in other words, you're probably not going to do what we would suggest. Certainly, we would suggest no third property. Absolutely not. And if I woke up in your shoes, I'd sell the rental and pay off my house as fast as I could, and then I'd save up and buy some rentals. Okay. I think you got in a hurry.
Okay. Yeah, I mean, we had worked with our real estate, who was an ELP, and she had suggested we keep on to the old property because it would be a good investment.
Yeah, most real estate people believe that, whether they're ELPs or not, but that doesn't mean they're not wrong. So, I mean, you can do whatever you want to do. I don't care. But just because one of our ELPs gave you the wrong advice doesn't mean that our advice is going to change. But the logic for my advice is real simple, that the peace and the lowered risk and the increased cash flow that having your home paid off does is it allows you to move on to other investments with cash, rather than, hey, I got a little debt over here, got a little debt over here, got a little more debt over on the third property now, and I got $2,000 a month, and you're just bifurcating all your efforts. You're spreading them out all over the place mathematically, and so that nothing tends to pile up because there's no laser focus. This is what the borrower is slave to the lender means.
And it's back to what we were talking about, I think, even the first segment of the show, of it's not always the math thing, right? Like that there you.
Well, that is a math thing.
But that's what I'm saying, though. Yeah, the math makes sense. But when you look at it, to be able to just say, hey, you just kind of have a paid for house, even though you're like, well, wow, there's a lot of equity here. We could keep it, make some good rental, like, right? Like the math of all of what he's saying, though, you understand it because with the risk.
His math is leaving out risk.
Right. That's what I'm saying. Without
when
the risk.
When you plug in risk, the benefits of leverage go away. And so this idea that there's good debt is just absurd. And truthfully, we've lived our lives for 30 years, and Rachel and Winston live their lives that way, and all the Ramsey kids, and we avoid debt, and that enables us to have all of our income to build up for other investments and other dreams and other things we can do, to where we're not supporting some stinking bank. And the great lie of America is that banks have told us for generations that the way to have your best life is do business with us. The way to have your best life is to get your credit card out. The way to have your best life is take out a home equity loan to go on that cruise. Oops, there's a COVID. And then you got a problem. And so it's there's always that oops. And so again, you do whatever you want to do. Obviously, you're not on the edge of bankruptcy or something, but you're not taking what I know to be the shortest path between where you are and wealth. It feels like it's the shortest path because you own this stuff, but you don't really own any of it because you're in debt on it. And so we highly recommend you go a more conservative, slower approach, and you will end up at the end of the story with more money. But it's very frustrating, and it's countercultural, and a lot of people don't believe it, but most people are broke. So I don't really care what they think about money.
Well, and the risk aspect, even you saying, spreading it out here, that property, this property, that, you just slowly start to build this house of cards. And then, pandemic hits. I mean, who knows? Life happens. And suddenly if your income stops and that renter who was in that property now can't pay their rent, well, you're out that cash flow that was helping you cash flow your regular mortgage. And it all just starts to crumble down really quickly. And so that risk is a key part to the story. And when you have no debt, there is no risk.